Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And throughout our presentation, we talk about statistical analysis. So now I'd like to talk about correlations because we're using these words interchangeably. So it's very important to make sure you have some basic foundation of what those key terms mean. So let's look at correlation. We see correlation throughout our statistical analysis. So all of our tools that do predictions use correlations, use seasonality. On the seasonal charts itself, you actually see the correlational numbers. So that's why I chose to go over the seasonal chart again and show where the correlation and why the correlation is important. So you can review graphs depicting the historical performance of each stock to help forecast future performance. This is what seasonal charts do. They show you how does the stock behave this year versus previous year. And if stock or ETF is correlated to historical price movements, that can give you an insight what is the likelihood that the stock will follow that correlation. It can also show you where the tops and bottoms are likely to occur. So what does the word correlation actually means? Let's go through the definition. In the world of finance, a statistical measure of how two securities move in relations to each other. And you hear the terms like covariance and non-covariance and modern portfolio theory. They all study correlations. And in order to predict stocks, you got to correlate the stock to some index or some baseline. So in this Wikipedia explains correlation to be computed into what is known as a correlation coefficient, which ranges between -1 and +1. Perfectly positive correlation, +1, implies that as one security moves either up or down, the other security will move in lockstep. Perfect example is in any given specific sector, like retail. Like right now we have Home Depot and Lowe's announcing its earnings. And Home Depot are highly correlated to Lowe's. They're in the same sector, same business model, they follow the same seasonal patterns. So it's very important to study these correlations to see actually if the certain stock or a bank will actually follow each other's pattern. You can look at Morgan Stanley and you can look at JP Morgan. You see that most of the time Morgan Stanley follows JP Morgan. If there is a binary event and the correlation is broken, it can happen for a short period of time, but from historical perspective, the correlation will revert to its mean. So alternatively, perfectly negative correlation means that if one security moves in either direction, the security that is perfectly negatively correlated will move in the opposite direction, mean coefficient of -1. So if you look at the seasonal chart, you can see on your screen correlation of 49% for SPY. So you can actually see how is the SPY, how is the current prices of the stock market correlated to its historical performance. And we know that the stock market usually sells off or trades in the range during summer. That's why you see June, July, August, September, we're in the range-bound trading. But starting with November and going into December, we're making new higher highs. And we kind of know this by our experience, but it would be nice to type in any ticker and find this seasonality and finding the correlation between how the stock behaves today versus how it behaved in the past. And if there is any correlation above 70%, that means there is a high statistical chance that the stock will follow its historical patterns. You can find more information if you go to tradespoon.com webinars, and you can also follow us on social media. Thank you.